How has Warren Buffett consistently beaten market crashes and recessions to grow his wealth to over $100 billion? More importantly, what are the investing principles and traits that have allowed him to protect his portfolio from markets exactly like the one that we're in right now? Principles that we investors can learn and use too.
I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote and never pay it. You don't need to pay attention to them. I mean, the main thing to do, and you're not going to pick the bottom, and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more and be comfortable with it as long as you're comfortable with the holding. And I pointed out, I think a year, maybe 2 years ago in the annual report, well, just the one before this most recent one, I pointed out that there have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred. But if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, I mean, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others. It's like the virus. It strikes some people with much greater ferocity than others. And fear is something I really never felt financially, but I don't think Charlie's felt it either. But, some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks because you're going to buy and sell them at the wrong time. And you should not count on somebody else telling you this. You should do something you understand yourself. If you don't understand it yourself, you're going to be affected by the next person you talk to. And so you should be in a position to hold. And I don't know whether today is a great day to buy stocks. I know it will work out over 20 or 30 years. I don't know whether it'll work out over 2 years at all. I have no idea whether you'll be ahead or behind on a stock you buy on Monday morning.
When Buffett first started, he was heavily influenced by Benjamin Graham. Benjamin thought that anyone could become a successful investor, but he split them into 2 types of investors. Now, the first type should invest in good quality companies called blue chips. You know, household names that you'd know today, like Google, Microsoft, Coca-Cola, etc. Knowing that the stock market averages around 7% a year, people will do well over time, especially since individual stocks tend to do better than the market average. However, the second type of investor, who has more time on their hands to do more research on the company and the willingness to learn about the companies, called fundamental research, can massively outperform the market. So you've got your 7% a year type of person. I mean, that's pretty good, right? And you've got this one that massively outperforms the market with a little bit of extra work. Now, obviously, Warren Buffett decided that he would do number 2, right? Spending hours reading company reports, looking for good, solid companies, which also have a competitive advantage over its competitors. And I'm going to talk about that in just a moment. But once good companies are found, when do you buy those companies? And that's where Buffett's mentor has a very interesting analogy. He famously described the stock market as this erratic individual called Mr. Market who has these wild mood swings.
The beauty of stocks is they do sell at silly prices from time to time. I mean, that's how Charlie and I have gotten rich. You know, Ben Graham writes about it in Chapter 8 of The Intelligent Investor. You know, well, Chapters 8 and Chapters 20 are really all you need to do to get rich in this world. And Chapter 8 says that in the market you're going to have a partner named Mr. Market. And the beauty of him as your partner is that he's kind of a psychotic drunk. And he will do very weird things over time. And your job is to remember that he's there to serve you and not to advise you. And if you can keep that mental state, that all those thousands of prices that Mr. Market is offering you every day on every major business in the world practically, that he is making lots of mistakes. And he makes them for all kinds of weird reasons. And all you have to do is occasionally oblige him when he offers to either buy or sell from you at the same price on any given day, any given security.
Sometimes Mr. Market is really depressed and the market goes down. Sometimes he's really happy and the markets go up, right? So you have this fluctuation. Now, Mr. Market's mood swings can be really extreme. So when the market goes down too much often, this is the best time to buy, according to Warren Buffett. But when the market goes up way too much, well, for most people, this is the best time to sell. While most people are influenced by the price movement, this movement, they get really emotional. Oh no, the market's going down, I need to sell. Buffett goes in with no emotion and actually takes advantage of the situation and starts buying when everyone is fearfully selling. There's a famous quote, by the way, from Buffett about how we should get greedy buying when everyone is fearful, and he also says selling when everyone is greedy.
If you have a temperament that when others are fearful, you're going to get scared yourself. You are not going to make a lot of money in securities over time in all probability. People really, if they didn't look at quotations, but of course the whole world is urging them to look at quotations, and more than that, do something based on small changes in quotations. But if you didn't, think how much more rational, we've talked about it before, but think how much more rational investing in a farm is than the way many people buy stocks. If you buy a farm, do you get a quote next week? Do you get a quote next month? If you buy an apartment house, do you get a quote next week or month? No, you look at the apartment house or the farm and you say, I expected it to produce so many bushels of soybeans and corn, and if it does that, it meets my expectations. But they buy a stock and they think if it goes up, it's wonderful, and if it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us to buy more.
Knowing that Mr. Market, with his wild mood swings, exists, I think is a real golden nugget if you get it. The ups and downs of the market, they affect most people, but not Warren Buffett, who calls them just background noise, to be ignored. Like literally, if the market crashes, he doesn't care. Now, Buffett famously said, price does not equal value. Just because the price of a company goes up and down, it doesn't mean the value of a company goes up and down. It's just background noise. So if a stock is down, let's say 20 or 30%, that doesn't mean that there's 20 or 30% less staff, 20 or 30% less profit or less factories, right? No, for Warren, it's an opportunity to buy. And most people, they do the exact opposite. It wasn't until Warren Buffett met Charlie Munger, his current mentor and business partner, that Warren really took his investing to the next level to create multi-billionaire status. He started to buy good, solid companies with good fundamentals, with now a competitive advantage over its competitors, right? Charlie Munger called this an economic moat. Think of a castle surrounded by water to stop armies attacking it, economic moat. For example, a brand, for example, Coca-Cola, because everyone has heard of the brand, right? So given the choice between branded product or non-branded product, most people would probably choose the branded product.
What we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle. What we're trying to find is a business that, for one reason or another, it can be because it's the low-cost producer in some area. It can be because it has a natural franchise, because of service capabilities. It could be because of its position in the consumer's mind. It can be because of a technological advantage, for any kind of reason at all, that it has this moat around it. And then what we have to decide is all moats are subject to attack in a capitalistic system. So everybody is going to try. If you've got a big castle in there, people are going to be trying to figure out how to get to it. We are trying to figure out why is that castle still standing, and what's going to keep it standing or cause it not to be standing 5, 10, 20 years from now? What are the key factors?
Buffett doesn't invest in stocks. He invests in companies, in businesses with good profits, good management, etc., who have this competitive advantage or economic moat. He doesn't get into a stock for a quick buck. It's not a stock for him, it's a company. Once he finds a good solid company at a fair price, Buffett will invest billions and then commit and be faithful to that company for years. He doesn't get in and out like most people. No, Buffett holds companies for years, for decades. For example, he invested in American Express, like Visa card, MasterCard, right? The card, American Express, around 1963, and he still holds it today. So he's held that company for around 60 years. These good companies will continue to grow, continue to generate profits, even paying dividends, which is just free money every year on top, making you rich over time. I mean, when was the last time that you held a stock for even 6 months or 6 years, let alone 60 years? Am I right? Buffett famously said that he didn't care if the market closes for the next 5 to 10 years because he's in it for the long term. In fact, his favorite holding time is forever.
It's not our natural inclination to sell. And on the other hand, and we have held the Washington Post stock since 1973. I've never sold a share of Berkshire, having bought the first shares in 1962. And we've held Coke stock since 1988. We've held Gillette stock since 1989. Held American Express stock since 1991. We had actually previously been an American Express in the 60s in Disney. So there are companies we're familiar with. We generally sell, we would sell if we needed money for something else, but that has not been the problem in the last 10 or 15 years.
If you now put the two together, value investing into good solid companies at a fair price, and the second being time and patience, which he certainly has, which is what investing really is, you have a winning combination. You see, Buffett's long-term view allows him to invest boldly while others retreat, as he's able to see past these short-term market fluctuations and focus on the long-term potential of a company. Remember, not a stock. Hence his phrase, buy when others are fearful and then hold forever. It's a very different philosophy to most people's, but the proof is in the pudding. Most people aren't worth over 100 billion. Warren Buffett is. Buffett famously only invests in what he calls his circle of competence, referring to areas that he's familiar with or understands deeply. And he avoids investing in businesses or industries that he finds either too complex or outside of his expertise, which is really interesting. See, for a long time, Buffett stayed away from tech stocks, even during the tech bubble of the late 90s and early 2000s. And he just claimed not to understand the business models, why they're worth so much. I don't get it. I'm not going to invest. However, this changed when he began to see value and understand the durable competitive advantage of companies like Apple.
To think that our criteria for Apple is different than the other businesses we own. It just happens to be a better business than any we own. And we put a fair amount of money in it, but we haven't got more money in it than we've got in the railroad. And Apple is a better business. Our railroad is a very good business, but it's not remotely as good as Apple's business. Apple, has a position with consumers where they're paying, maybe they pay $1,500 or whatever it may be for a phone, and these same people pay $35,000 for having a second car. And if they had to give up a second car or give up their iPhone, they'd give up their second car. I mean, it's an extraordinary product. We don't have anything like that we own 100% of, but we're very, very, very happy to have 5.6 or whatever it may be percent, and we're delighted every 0.1% that goes up. It's like adding $100 million to our earnings. I mean, our share of the earnings, and they use the earnings to buy out our partners, which we're glad to see them sell out too.
He didn't understand them before, so he didn't invest. But once he understood them, he invested. And then he took a significant position in Apple in 2016, years after Apple came about. Not at the beginning, years after, which has since become one of Berkshire Hathaway's, his company's, most valuable holdings. So maybe for you, start with an industry that you like or that you work in maybe, and then do your research on some famous public companies in that industry. You probably know their name. Then wait for a drop in price, buy into it, and hold. In many ways, Buffett's choices are very conservative, almost defensive. He doesn't buy into what's hot right now, like artificial intelligence that everybody seems to be jumping into. No, only huge, well-known, well-run companies. It's got me thinking, why? It's because he is famous for his two rules.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
He's just not interested in the latest, most speculative, exciting hot stock. His primary goal isn't to make money, but not to lose it. Yet he's made billions in the process by carefully selecting only those businesses that will stand the test of time, and I mean time. Does this long-term, quality-focused approach resonate with you at all? Click the link below if you want to learn more about how to invest like Warren Buffett. You'll get weekly investing insights directly into your inbox to help you build long-term wealth. And we'll also give you access to our online training portal packed with the tools and strategies that you need to take your wealth into your own hands. All this for free. Now, as we were discussing, this patient, disciplined approach seems to be very, very different compared to most beginner investors who want to make a fortune quickly on the next hot stock, right? So, let's now dive into his portfolio and see what is he investing into right now and see whether we can find any clues for us. So Buffett currently has 48 holdings in his portfolio, which is really interesting. I'll come on to that in just a moment because that's interesting in itself, because there's a theme here about diversifying and over-diversifying. But let's go through his top 10, his biggest holdings, right? So the first one, we've already mentioned, it is Apple, right? The sector is technology, and the industry is consumer electronics. I'm sure you know Apple, or at least have heard of Apple. And, you know, who would have thought, honestly, even a few years ago, 10 to 15 years ago, that this would be his biggest holding, because he generally just used to stay away from technology, which is really interesting. So he's adapting. But then we come into what I consider to be a really defensive list here, because if you look at it, Bank of America, right? The sector's financials, the industry, well, what is it? Well, it's a bank, right? Bank of America. I think the name kind of gave it away there. You know, these are the kind of things that, I mean, you could argue this point, of course, but he believes is very, very solid, almost boring. That's the kind of thing that he invests in, you know. Number 3, American Express. I've already mentioned this. Again, the sector financial credit card company. I mean, they have a brilliant business model because if you think about it, most of the marketing is not really done by American Express. It's done through the carriers, like the banks, for example. So all they do is provide a service to the banks that go out and do the marketing for it. It's actually brilliant. Next one, Coca-Cola, right? Coca-Cola. I mean, Coca-Cola. He's held this one for years. Consumer staples, non-alcoholic beverages. In fact, number 5, Kraft Heinz is also consumer staples. Now, why is that so important? Because what is a consumer staple? Well, it means that the consumers are always going to be buying it, no matter what happens in the market. You know, even if the market goes down and people are feeling the pinch financially, they're still going to reach for Coca-Cola. They're still going to reach for the Heinz ketchup. So it's a consumer staple. So it's very clever. See the defensive play that he's doing here? And then Chevron. I mean, you know, energy company integrating oil and gas. Everyone's heard of Chevron. It's like, you know, I'd look at this and I'd go, oh, it's a bit boring, but that's his play, you see? And he is worth over 100 billion. It's brilliant. It really does change your thinking about things. Look at this, number 7, Verizon Communications. I mean, it's a wireless carrier. Everybody uses it in the States, right? It's telecommunications. And then you have 2 more banks, US Bank Corp, Commercial Bank and Wells Fargo, one of the largest banks in America, And then comes number 10. And this really surprised me. It's Snowflake. Right? You might not even have heard of this company. You've heard of probably all the others, am I right? But here comes Snowflake, a technology company which does cloud computing. Who would have thought? Snowflake, cloud computing. Now, I promise you, 10 to 20 years ago, Warren Buffett would have said, I don't understand. What is this cloud computing thing, right? What is it? I don't understand it. 100%, that's how he thinks, right? Therefore, I won't invest in it. But look at this. Number 10. And I mean, he's got 48 holdings, so there's a lot of money in this. We're not talking about a few million here. We're talking about a lot of money here in cloud computing. Very, very interesting indeed. However, most of them very defensive. Now, like I said, Buffett currently has 48 holdings in his portfolio, which is interesting because he always says, don't over-diversify. And that's quite diversified, no? 48 companies. But then again, his problem is he has too much money and he has to allocate it somewhere without buying entire companies. That's what he does. He buys entire companies. So below in the description box, you'll find a website link of all of Berkshire Hathaway's holdings, updated daily by CNBC, and also the official website link with the SEC, the Securities Exchange Commission. Buffett's portfolio changes constantly as he buys and sells stocks. Immediately, you can see his investing approach. Solid companies who have stood the test of time. And one surprise. But you don't see the latest AI stocks, do you? No. Instead, we see Coca-Cola, a stock which he has held onto for over 30 years now. In 1988, Buffett started acquiring Coca-Cola stock at an average price of around $5 per share through his company Berkshire Hathaway. And by 1995, Berkshire had built up a 7% stake in Coca-Cola worth $1.2 billion and became the largest shareholding. And as of 2018, Berkshire held 400 million shares of Coca-Cola stock worth about $19 billion, making it its third largest public stock holding. Now, Buffett credits Coca-Cola with producing some of Berkshire's best investment returns over the decades. He is well known for holding positions for very long periods, like I said. And by the way, at all his meetings once a year, what does he drink? Coca-Cola. Now, even with some recent decreases in soda consumption, Buffett has stated he has no plans to sell the Coca-Cola shares and still believes in the company. I'm telling you, he's in it for the long term. He's not timing the market. So, are you looking to get into the latest hot, trendy stocks? That's not what the most successful investor in the world is doing. Are you trying to time the market? Buffett wouldn't. Are you looking for a quick profit, getting in and out? I'm telling you, Buffett wouldn't. So, to summarize, take a long-term view when investing in quality companies. Buffett does his homework to find businesses with strong fundamentals and a competitive advantage that can stand the test of time. He's not focused on short-term gains, right? Number 2, don't try to time the market. Buffett buys great companies, remember, at fair prices, no matter what the broader market is doing. He tunes out the background noise and the volatility. Number 3, stay within your circle of competence and don't over-diversify. Buffett sticks to industries that he understands well and concentrates his holdings on his best ideas. Is there something to learn here? Time to change your investment approach to get the same results as a multi-billionaire? Thanks for watching. Subscribe and click the bell to get notified of future videos like this one. We'll see you next time.